Between 1929 and 1933, the American economy collapsed. 13 million people lost their jobs, 9,000 banks failed, families were evicted from their homes, farmers watched their land being auctioned off, desperate men jumped from Wall Street windows. The Great Depression destroyed the lives of millions. But here's what they don't teach in history class: while ordinary Americans lost everything, a small group of men became extraordinarily wealthy. They didn't just survive the crash, they engineered it, and then they bought America for pennies on the dollar. The question isn't whether the Great Depression happened. The question is who profited and how did they know it was coming. Here, where history, power, and economics meet, we reveal the truths that shape civilizations. On October 29, 1929, Black Tuesday, the stock market crashed. 16 million shares were traded in a single day. Fortunes evaporated in hours. By 1933, stock values had dropped 89 from their 1929 peak. The official narrative says it was speculation gone wrong, an inevitable correction, a tragic accident, but the evidence tells a different story. This was the greatest wealth transfer in American history, and it was planned. In the years leading up to 1929, ordinary Americans were encouraged to invest in the stock market. Newspapers celebrated the new era of prosperity. Banks offered loans to buy stocks with only 10 down, a practice called buying on margin. Everyone was getting rich, or so it seemed. But behind the scenes, the insiders knew something the public didn't. The market was a bubble, and bubbles always burst. Here's the paradox: in September 1929, just weeks before the crash, some of America's wealthiest men began quietly selling their stocks. Joseph Kennedy, future patriarch of the Kennedy dynasty, sold his entire portfolio. The Rockefeller family reduced their holdings. J.P. Morgan partners liquidated positions. They knew, and they got out, but they didn't warn anyone. While they were selling, they were publicly telling Americans to keep buying. Sound stocks are good value, they said. The market is fundamentally strong. It was a lie, and millions believed it. To understand how this happened, we need to go back to 1913, when the Federal Reserve was created. The official purpose was to stabilize the banking system and prevent panics. But the Federal Reserve wasn't a government institution. It was, and still is, a private consortium of banks, and those banks had enormous power to expand or contract the money supply. In the 1920s, the Federal Reserve deliberately kept interest rates low. Cheap credit flooded the economy. People borrowed to invest, companies borrowed to expand, banks borrowed to lend more. It was a debt-fueled boom, and when you pump an economy full of cheap credit, you create inflation. Asset prices soar, everyone feels wealthy, but it's an illusion. By 1928, the Federal Reserve began raising interest rates. Credit became expensive, borrowing slowed, the economy cooled, and the stock market, which had been rising on borrowed money, began to wobble. The insiders saw it. They understood what higher interest rates meant. They knew the party was ending, so they sold. When the crash came, it wasn't gradual, it was catastrophic. On October 24, 1929, panic selling began. By October 29, the market was in freefall. Investors who had bought on margin were wiped out instantly. When stock prices dropped, brokers demanded more cash as collateral. If you couldn't pay, your stocks were sold at a loss. Millions of Americans lost everything in a matter of days. But here's what happened next. While ordinary people were selling in desperation, the wealthy were buying. Joseph Kennedy made a fortune purchasing undervalued assets during the Depression. John D. Rockefeller continued buying stocks throughout the crash, famously saying, "These are days when many are discouraged. In the 93 years of my life, depressions have come and gone. Prosperity has always returned." He was right, but only for people like him, because he had cash. Most Americans didn't. They were drowning in debt, unemployed, desperate. They had to sell their homes, their land, their businesses just to survive. And who bought those assets? The same men who had sold at the peak. Andrew Mellon, Treasury Secretary under 3 presidents and one of the richest men in America, allegedly said, "Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, purge the rottenness out of the system." Whether he said those exact words is debated, but that's exactly what happened. Assets were liquidated, and the wealthy bought them. Between 1929 and 1933, 9,000 banks failed. When a bank fails, depositors lose their money. There was no FDIC insurance back then. If your bank collapsed, your savings disappeared. Millions of Americans lost their life savings overnight. But the big banks, the ones connected to the Federal Reserve System, survived. They had access to emergency loans, they had liquidity. Small banks didn't, so they failed. And the big banks absorbed them. This wasn't an accident, it was consolidation. Before the Depression, America had thousands of independent banks. After the Depression, banking was dominated by a few powerful institutions. J.P. Morgan, Chase, Bank of America. They emerged stronger, bigger, more powerful than ever. The same pattern played out in industry. During the Depression, thousands of companies went bankrupt. But a few corporations expanded. General Electric bought competitors for pennies. IBM grew. Standard Oil consolidated. The wealthy didn't just survive the depression. They used it to eliminate competition and dominate entire industries. And here's the most disturbing part: the depression didn't have to last 10 years. The economy could have recovered much faster. But it didn't, because recovery would have meant inflating the currency, making credit cheap again, helping debtors. And the creditors, the bankers, the wealthy, they opposed that. They wanted deflation, because deflation makes money more valuable. If you're holding cash while prices drop, you get richer without doing anything. Your purchasing power increases. So they fought against inflation. They demanded the gold standard be maintained. They opposed government spending. They wanted austerity, and they got it for years. While ordinary Americans starved, the Federal Reserve kept money tight, credit remained scarce. Businesses couldn't borrow. Unemployment stayed above 20. It was only when World War II started, when the government was forced to spend massively on the war effort, that the Depression finally ended. But by then, the damage was done. Wealth had been transferred, power had been consolidated. The men who profited from the crash were now richer and more powerful than ever. Joseph Kennedy used his fortune to launch a political dynasty. The Rockefellers expanded their empire. J.P. Morgan became even more central to American finance. Here's the truth they don't want you to understand: the Great Depression wasn't a natural disaster. It was a controlled demolition. The insiders knew the boom was unsustainable. They knew the crash was coming. And instead of preventing it, they positioned themselves to profit from it. They sold at the top, they bought at the bottom, and they used the crisis to destroy competitors and consolidate control. This isn't conspiracy theory. This is documented history. Congressional investigations in the 1930s revealed rampant insider trading before the crash. Senate hearings exposed manipulative practices by banks and brokers. Ferdinand Pecora, chief counsel for the Senate Banking Committee, uncovered shocking evidence of fraud and self-dealing by Wall Street elites. His investigations led to the creation of the SEC and banking reforms, but the damage was already done. And here's the pattern you need to recognize: this keeps happening. Every major financial crisis follows the same script. Credit expands, asset prices rise, insiders sell, the market crashes, ordinary people lose everything. The wealthy buy assets at discount prices. Wealth concentrates at the top. It happened in 1929, it happened in 2008, it happened in 2020. In 2008, the housing bubble burst. Millions of Americans lost their homes. Banks were bailout out with taxpayer money. And what happened next? Hedge funds and private equity firms bought foreclosed homes in bulk at bargain prices. They turned homes into rental properties. Wealth transferred from homeowners to landlords. The pattern repeated. In 2020, during the pandemic crash, the stock market dropped 34 in March. Small businesses closed, workers were laid off. But by the end of the year, the stock market hit record highs. Why? Because the Federal Reserve printed trillions of dollars and pumped it into financial markets. Who benefited? People who own stocks. The wealthy, meanwhile, small businesses failed. Millions lost their jobs. Wealth inequality reached historic levels. The system isn't broken, it's working exactly as designed. Financial crises aren't accidents, they're features. They're mechanisms for transferring wealth from the bottom to the top. And the people who control the system, the central bankers, the financiers, the insiders, they know this. They see the crashes coming, they position themselves accordingly, and they profit. What sustains this system isn't gold. It isn't dollars, it's the illusion that it's fair. The belief that anyone can get rich if they work hard enough. The myth that the market is efficient and rational, but it's not. The market is manipulated. Information is asymmetric. Insiders have advantages that ordinary people never will. And when the crash comes, they're ready, you're not. This is why financial literacy matters. Not just understanding how to invest, but understanding how the system actually works. Understanding that central banks control the money supply. Understanding that cheap credit creates bubbles. Understanding that when everyone is euphoric about the market, insiders are selling. Understanding that crises are opportunities, but only if you see them coming. The men who profited from the Great Depression weren't smarter than everyone else. They just had information and resources that others did. They controlled the levers of power, they made the rules, and they broke them when convenient. Joseph Kennedy made his fortune through insider trading and stock manipulation. Practices that would be illegal today. But back then, there were no rules against it. And even now, with regulations in place, insiders still profit. They just do it more carefully. Here's the uncomfortable truth: every great fortune in America has origins in exploitation, manipulation, or crisis. The robber barons of the Gilded Age built their empires through monopolies and corruption. The financial titans of the 1920s profited from the crash they helped create. The tech billionaires of today benefit from regulatory capture and network effects that eliminate competition. Wealth doesn't trickle down, it flows up, and it accelerates during crises. The Great Depression destroyed the middle class. Millions of families fell into poverty, farmers lost their land, workers lost their jobs, small business owners lost everything. But the wealthy emerged richer than ever. They bought land at auction prices. They purchased stocks at depression lows. They acquired companies for pennies on the dollar. And when the economy finally recovered, they owned more of it. This is the pattern. This is the truth. Financial crises aren't tragedies for everyone. They're opportunities for those with capital. And the system is designed to ensure that those with capital stay on top. Central banks provide liquidity to big banks but not to ordinary people. Governments bail out corporations but not workers. The rules protect the powerful and punish the vulnerable. And it will keep happening, because the same people who profited from past crises still control the system. The Federal Reserve is still run by former bankers. Wall Street still has enormous political influence. The revolving door between government and finance ensures that policies favor the wealthy. And when the next crisis comes, and it will, the pattern will repeat. Insiders will sell. Markets will crash. Ordinary people will lose. The wealthy will buy. Wealth will concentrate. Unless people understand how the system works. Unless they recognize the patterns. Unless they refuse to participate in bubbles driven by cheap credit and speculation. Unless they demand accountability from those who manipulate markets. Unless they build systems that prioritize stability over profit, fairness over exploitation. The Great Depression wasn't just an economic event, it was a moral failure. A failure of leadership, of ethics, of humanity. The men who profited could have warned people. They could have pushed for reforms before the crash. They could have used their wealth and power to help millions who suffered. But they didn't, because they prioritized profit over people. And that choice shaped the next century of American capitalism. If this gave you a new perspective on how power and money really work, subscribe. History has the answers. It'll show you where to look.